pensions at the moment are quite a big thing. There's been lots of changes at the moment in terms of the industry, in terms of what's going on in terms of taxation. So yeah, we're getting a lot of inquiries at the moment from clients about, what do I do with my pension? Am I, doing the right thing by saving into a pension still? Is it still the best way to save? And technically at the moment, yeah, it still is the best way to, save tax efficiently for retirement.
Yeah. Okay. I think there's plenty to come on to with this, and I know where I'd like this conversation to go, certainly around more recent announcements and what people should be thinking about come inheritance tax changes in 2027. But let's strip it back to the start, and if you could just open up by just sort of talking about what is a pension and why you would advise anybody really to start and open a pension.
Mm-hmm. So essentially a pension is just a pot of money that you save into for, ideally for retirement. Technically it's still the best way to save for retirement because of the tax breaks that you get. So any time that you put money into a pension, so for example, for £100 that you put into a pension of personal money, the government will add in £25 for you. So effectively that is free money that you're getting. If you're a high rate taxpayer, you can claim further monies into it. So if you put £100 in, you could claim another 25. So technically that's £50 that you've got on top of your 100 straight away. And there's nothing in the market that will give you that sort of return straight away on your initial investment. Your money grows tax-free as well. So at the moment, obviously with interest rates as they are, a lot of people are saving in normal savings accounts, but you're getting taxed on it. With a pension, there's no tax at all. So at the moment, it still remains the best way to grow money tax-free and tax efficiently.
And quite often, some of the conversations I have with clients that maybe have a business and have some excess cash that they want to put aside is pensions versus property investment. And certainly that side of things has been really hit hard with changes to tax rules and other more sort of structural changes around property investment. But you're saying with pensions, certainly on the way in, that the tax relief has remained unchanged. And actually, some of the limits of putting money into pensions have risen in recent years as well. So, as we record this, certainly pensions should be top of the list as to where people start. So there are different types of pensions, of course, and I guess we're slightly more familiar with the more public sector type pension where the pension amount is guaranteed, and the more private sector pensions whereby it's like a savings account and you're exposed to the markets. I wondered if you could just talk us through sort of the key aspects of those two and maybe move on to talking about things like SIPPs where you have more control.
Yeah. So with a personal pension, that's your standard type of pension. Effectively, it is a pot of money. You can decide whether it invests into cash or whether it invests into a series of managed investment funds. It depends on the risk that you want to take with your money, but depending on that risk, depends on what it goes into. Ideally, you want to try and spread your money into lots of different things, depending on the risk that you want to take and how long you've got left to retirement. As you come up to retirement, ideally you want to take less risk because of the amount that your money can go up and down in value. So if you get to a point within the next sort of 5-10 years that you're going to retire, you want to try and reduce the risk just in case there's a market fall that could trigger your pension fund dropping, and then that could affect your retirement plan. So that's something that we work with clients on to make sure they've got the money invested at the right risk for the right time horizon, and obviously it's sort of they roll up to retirement at the right risk level. In terms of sort of other types of pensions, a SIPP, so a self-invested personal pension, SIPP, is a good way. It gives you other options that you can invest into other than managed investment funds and cash. So, for example, you could invest in things like national savings. So if you wanted to, just put your money into a national savings account, earn a guaranteed rate of return if you didn't want to take a risk, or, if you're coming up to retirement and you want to de-risk, then that's a good option. Also, you can invest through a SIPP into just ordinary bank accounts. So if you're a saver that just normally likes day-to-day bank accounts, doesn't like putting money in stocks and shares, and that's something that's your preference, then with a SIPP you can invest in that option. Other things through a SIPP is you can invest in commercial property as well. You used to be able to invest in residential property, but the government took that option away. So commercial property is looking, if you want to set up, say, some units for a business to invest into, you can put money into something like that. Also, you could, for example, if you're a self-employed person that has a business, or you're a company director that owns a company, you could potentially buy your property through your SIPP as well. And technically you rent that back to your business. So it gives you, with your retirement pot that that you've built up over the years, more choices rather than just investing in sort of simple cash investments or stocks and shares. Especially if you do have your own business, that is, for most people, their money that they are saving for retirement, but you could use it now for the purpose of your business.
Yeah, I think that's where I see SIPs come in more commonly with my client base is where group of company director shareholders have a commercial property that they own or have the opportunity to purchase for their business, buying that within a SIP. So routing money into a pension, building up those funds and using those funds to purchase that commercial property. Couple of really good tax advantages there is that the rent is deductible within the business but not taxable in the SIP, of course. And also capital growth on that property is also protected from tax, isn't it? So the SIP from that scenario can work really, really well. The key is, I think, is planning. If you want to buy commercial property in a SIP, from my perspective, you can't just sort of turn around and say, right, let's mortgage 80% of this and put it in a SIP. It's tricky. You kind of need to have rooted the cash into a pension to grown that up in advance over a few years. Yeah,
that's it. I mean, one of the things from going into commercial property is it's more a long-term thing. I mean, if you're going to retire in the next few years, you have to know that, if it's in a property, you've physically got to liquidate that property and sell it before you can convert it into cash to then use that as a pension income. So ideally you want to be going into commercial property, probably looking 5-10 year period. And of course, if you do retire, if you do have your own business, if you sell your business, you could still keep that property ownership within the SIP. And if you're renting that to, let's say, whoever you sell your business to, or if your business continues, any rents you receive, you could take them out as an income. You've just got to make sure you've got the cash in the actual pension. So what we do recommend to a lot of clients is if you are going to invest in commercial property, make sure that there's some cash in there as well, especially if you are coming up to retirement. So if you do need to draw some money out, for some people, when they retire, they might want to draw some money out to go on, a world holiday or, do something with the house, give money to family, that sort of thing. If you have some cash available, then, that's probably the best way to invest into a SIP using commercial property. But also, I mean, for a lot of clients have different pots within their pension. So you could invest in commercial property, maybe have some in stocks and shares, some in cash, and then you've got your fingers kind of in all pies then, really. And ideally, I mean, if you're coming up to retirement, you just want to make sure that there is money that you can take out easily without having to wait for the sale of a property.
So that diversification of the portfolio is important.
Yes.
And you touched on earlier the aspect of the risk and the investor and the client's attitude to risk. If we could just go back to that for a second and explain that process, because I assume you're not sitting down with one of your clients and saying, right, here's 200 different funds, which ones do you want to invest in? In terms of judging what somebody's attitude to risk is and therefore where their money is invested, what does that process look like in a nutshell?
No, it's a good question. So we have something called a risk profiling questionnaire that we work with clients on. So we send them the risk profiling questionnaire. It asks them a series of questions about how they feel about risk, how they would feel if their money was to go up and down, how they would feel if they were to lose money, because obviously in stocks and shares it can go up and down. Technically, the only way you can lose money is to take it out when it's down, because it's on a cycle of ups and downs all the time. But it works out the questionnaire that we have on a scale of 1 to 10, how somebody feels about risk. So 1 being low risk, 10 being high risk, and where it comes out, we can then recommend suitable investment funds and a balanced portfolio around that risk level. So what that takes into account a lot of the time is, how they feel about risk. We also take into account when their time horizon for retirement is. So we would sort of indicate if somebody came out quite high up the risk scale, but let's say they were retiring in 2 years' time, we might point them in the direction to say, well, actually, you sure you want that level of risk? Because what happens if your 100,000 in there drops to 20,000, for example, and you've only got 2 years to retirement? So it's an indicative tool that we use to sort of put someone on a scale, but then we talk around it with them as well to find, right, what's the appropriate risk level. And at the moment, I mean, for some pension funds, some personal pension funds, and also some SIPs, there's probably between 4,000 and 5,000 different investment funds out there they can invest into. And we would recommend, based on their risk level, time horizon, what they want to do, whether they want to grow the money, take some income, bit of both, what the suitable funds are, and we'll put the portfolio together for them. And then what's important is they will review that at least once a year as well as they get closer to retirement and the needs change as well.
I was going to say that must be a big part of your role, is to not just undertake this process, but ongoing annually, on a periodic basis, because we all get older and near retirement, but also things in life change and our attitude to risk may change alongside that. And so one of the advantages I see to having an arrangement, a relationship with a pension advisor like yourself, John, is that it's that ongoing level of service, constant review, and just tweaking or significantly changing, if that's what's required, your investment choices and where you're heading towards retirement, rather than making that decision at 25 when you start your first pension and kind of leaving it. That's so important, isn't it? That ongoing advice.
Yeah, it is, absolutely, because things change all the time with investment funds, for example, let alone, clients' goals and wishes. So, I mean, if you think of it like, if you had 100,000 in a pension fund, you'd want to definitely make sure that you keep that, serviced. Yeah. Same as if you had a £100,000 car, each year you'd want to make sure it's serviced, keeps it running, etc. And we could invest, say today, money into the best investment fund with the best performance history that's out there, but it could change tomorrow. It could be the dynamic in the fund changes. A manager who's been running it for 20 years could leave, go somewhere else, and all of a sudden that fund, we don't know what it's going to do. So we have an analytics system that we use behind the scenes for our clients, where we sort of match what a client's got against what's out there, how's it performing, in terms of what we expect, and we can recommend to a client a change in the fund if need be, or whether they stay, where they are. But yeah, absolutely, annual reviews are definitely important to make sure they're on track for their retirement goals and how their money's invested is in the best place as well. And
of course, we live in quite a turbulent world at the moment with wars and conflicts and economic crises all over the world. And so I imagine certainly over the last few years, a big part of your role with your clients has been to reassure, to speak to people and understand their concerns, because there's a lot of press around sort of falling stock markets, currencies, inflation and such like, and so understanding how that impacts each client's portfolio and sort of dealing with those queries must be quite important for you.
Yeah, absolutely. I mean, it is making sure that they are in the right place for their current situation, but also looking to the future, that we're on the right line to sort of achieve what they want to achieve when they want to achieve it. So the constant dialogue between the two of us, even if it is just once a year, is really important. The last couple of years or so, certainly since the Ukraine war started, we've found that a lot of clients are more worried than ever they have been. In terms of the pension funds, a lot of them are looking more online because we give them access to how the fund's performing, and calling in, sending emails, and just saying, "Is this okay?" So we've found more than ever in the last sort of few years that people do need a bit of hand-holding, but that's what we're here for. It isn't just to advise, right, here's the best pension, here's the best investment, off you go. It is that constant sort of hand-holding, the reassurance there. And we have all the metrics and systems that we can say to them, right, your fund is in the right place based on what you've told us, and sometimes that reassurance is just what they need, especially with all this constant social media, news, etc., news cycles. So yeah, that's been a big part of our business in the last few years, is just the reassurance part and managing clients.
Let's turn to tax, because I think tax is one of the driving forces behind why people get into pensions. And generally speaking, it's tax relief on the way in and potential tax charges on the way out. But we'll delve into that a little bit more deeply. So in terms of routing money into a pension, you touched earlier on those personal contributions, whereby there's a £25 for every 100 you invest, which is added to the value of the pot, and then another 25 if you're a higher rate taxpayer. For business owners who have the option of their company or business paying those contributions for them, the tax relief is slightly different, isn't it?
Yeah, it is. So it works more in favour of the business. So, for example, I mean, let's say a business made £100,000 profit. Let's say the corporation tax rate was 19%. So technically, that tax bill for that year is £19,000. If they were to put all of that profit, let's say, into the pension, just theoretically, because you've got annual limits that you can use, and we can touch on that. But if you were to put 100,000 into the pension, what would happen is, because that class is a business expense, that would almost zero the profit that year for the company. So there's no tax at all for the company to pay, and they've just managed to get £100,000 into their pension without any tax at all. So it's a really, really tax efficient way to get money out of a business, as opposed to extracting it through, say, dividends, salaries, where normally they would pay some sort of tax. Obviously they come within the tax bands. So, I mean, for everybody that we see, and certainly I've been on a mission the last few years for any client that I see that has a limited company, is to say, look, have you got a pension, and are you actively using it as a way to extract money from your business? Because it's a very, very tax efficient way to do it.
Yeah.
And for a lot of clients at the moment, because the minimum age you can access pension funds is 55, if we have clients that are 55 and over, and I had one last week, for example, where he took 40,000 out of the business, put it into the pension, and then drew £10,000, which is 25% tax-free straight out.
Yeah.
So technically, he just got 10,000 out of his business in his pocket with
Yeah.
no tax whatsoever. So it's a really good tax planning tool to use, especially for people who have limited companies.
Yeah, certainly some of the discussions I have with my clients with limited companies in that very scenario, quite often we focus in around the marginal rate of corporation tax because, for those of you that aren't so familiar with this, the 19% is the lower rate, 25% is the higher rate of corporation tax. But in the middle ground there's a marginal rate of 26.5%. So quite a lot of planning. Doing some of this just last week was talking to the business owner about where do we think profits are likely to be this year. And actually, if we pay that 15 grand as it was pension contribution pre-year end, that brings you down from a marginal rate of 26.5% down to the 19% rate on all your profits. You've effectively got 26.5% tax back on that pension contribution, which is quite significant. But it's important, I think, to understand that there's these sort of two different routes. The corporate route, tax relief, is absorbed in the company's corporation tax bill.
Yes. Yeah.
For individuals with their own cash paying that into a pension, there's an additional contribution into your pension pot, so it increases the amount you put in, as you touched on previously. Yeah. Plus, if you're a higher rate taxpayer, there is some tax saving there as well. But get advice around those two, whichever situation you're in. And then, if we just turn, John, to taking the money out of the pension, you alluded to it a little while ago, which is the tax-free lump sum. Talk to us about that.
Yeah, so at the moment, you can still take 25% of your pension pot tax-free. It's up to a capped limit. So at the moment, the lifetime allowance, I believe, is $1,073,000, or it's the old, what they call the lifetime allowance. 25% of that, which is roughly about £250,000 or so. That's the cap on how much you can take out as tax-free cash. So as long as your pot's less than £1 million, pretty much you could take £250,000 out. You don't have to do it in one lump sum. You can do it, in chunks throughout your lifetime, and you could use that tax-free cash potentially as an income as well. So if you do want to take money out of your pension, but you're still earning, and you're worried that you might have to pay tax on it, if you take it out of the tax-free cash, technically it's additional income or additional lump sums that are tax-free. Yeah. But that's one thing that the government has done in the last year or so. There's been a lot of rumours where people think, the tax-free cash is going to completely disappear. We don't know with the current government whether that is a plan or not, but what we do know at the moment is you can still take 25% of your pot, but it is capped. Yeah. They might change the caps, but that's, again, what we're here for, giving advice to our clients. When we hear there are changes in budgets, we'll notify clients. Yeah,
so put simply, 25% tax-free, the remaining 75% is charged to tax, and that would be charged to income tax. So think of that 75%, how much you choose to draw in that tax year as your income for the year. If you're preparing a personal tax return, say you're drawing £25,000 from your pension scheme, that would go on your tax return. You'd have your personal allowance, and you would pay income tax at 20, 40 or 45%, just like you would salary income, rental income, something like that. Yeah. And so planning around how much to draw each year, how much tax-free and how much taxed pension funds, I assume is another aspect of your role that's important.
It is, yeah. I mean, we define it into two stages. So accumulation is the building up of your pension pot, and then de-accumulation is, drawing from it, using it for retirement. What's absolutely important on the de-accumulation side of things is making sure that if you do want to draw regular income, etc., there's two things that you consider. One is that you draw enough to make sure that it lasts, so it doesn't run out during your lifetime. To do that, we can use systems called cash flow models, where we can almost predict in the future and look at sort of from modelling what a client expects to spend, regular income, lump sum events, that sort of thing, maybe like weddings for children, etc. Also looking at future taxation, future charges of the pension funds, and we can technically, work out based on what they anticipate as the spending patterns, how long that money will last for, and whether they can do what they want to do in retirement. One thing a lot of people don't take into account is the state pension, because potentially that could give you, between £10,000 and £12,000 a year per person on top. And that's one thing we'd always say to clients is make sure that you've got your state pension up to date. You can go online and obviously check that. The second thing is we look at tax planning as well. So obviously we can work with accountants to make sure that as clients draw their money, they do it in the most tax efficient way. So as you alluded to, I mean, tax-free cash is the best way to take money if you completely tax-free. But if, for example, they have no income, they've still got the personal allowance of $12,570. So technically, if they wanted $25,000 a year, they could take $12,500 taxable income plus $10,000 tax-free, and you've got $25,000 tax-free per year income. So key things are for de-accumulation, making sure that you take the right amount to make sure it lasts, but also that you tax plan and you don't pay more tax than you need to.
Yeah, and that's important, isn't it? I think when I speak to clients, sort of tongue-in-cheek, we say the best strategy is to make sure that you have enough so that you don't run out of money, but you don't leave any behind when you die. But of course, there's a big variable there that nobody's in control of. So let's have a chat now about what happens if you die with undrawn pension funds there. And I understand the age of 75 is quite important on that one.
Yeah, absolutely. So at the moment, the key age of 75 is there. So if you pass away before age 75, technically you can pass funds tax-free to your beneficiaries. After age 75, if you pass away, then whoever you leave it to could pay tax on receipt of that at their marginal tax rate. So if they're 20%, 40% taxpayers, they'll pay tax accordingly. Now, the changes that are coming, potentially they're saying from 2027, the government announced this last year in the budget, from April 2027, are that if you pass away after 2027, it could be that your money in your pension is subject to inheritance tax, but also whoever receives it could receive that money paying tax as well. So there's almost a double hit there. So you've got inheritance tax that could be charged at 40% on your pot if your estate's over £1 million for a couple, let's say, with all the allowances that you've got. Plus whoever receives it could pay tax as well. So it's going to change potentially the way that we give advice, because we've always said to clients that we have, if you've got cash funds, use those first and then use your pension last, because the money in a pension's outside of your estate for inheritance tax. But now it could be we use pensions first, take the tax-free cash out maybe, because that's then less that could be charged against inheritance tax. So it's going to change the way, the new rules that are coming up in 2027 is going to change the way we give advice. We're still kind of working it out at the moment because it isn't actually in tax law, but we know it's coming.
Okay, so the age 75, just so I can sort of clarify this, is whether the beneficiary, the receiver of that pension, has to pay their own tax on it or not. But the pension pot being subject to inheritance tax from 2027 onwards, the age 75 is not relevant to that. That is all pension pots that are left behind on death.
So it could be, so the 75 is still going to be there. So what will happen from 2027 is the pension pot will be fully accessible for inheritance tax.
No matter how old somebody was when they passed?
Yes. The 75 is whether the beneficiary pays tax on receipt of it or not. So if they're under 75, generally there won't be any tax. If they're over, then there will. So if you pass away after 75 and you've got quite a big estate, it could be quite a lot of tax. But again, that's what we're trying to work out at the moment, is how we would give advice. We can't say to clients at the moment, change your plans because it's not in tax law yet, but we can start thinking about ways that we might look at, in the future to try and plan for, that event and tax planning.
So that's some of those scary sort of percentages that we've seen quoted. So if you imagine a pension pot that is subject to 40% inheritance tax, so 60% of the pension is passed on, and then if the beneficiaries, the children, are paying tax at 45% themselves, and that 60% less another 45%, you can easily get to a figure of 30% or so of the original pension amount that's being passed on. And for many people that have been, as you say, planning for so long to use their pension as a strategy to pass wealth to their children and beneficiaries, this is let's say, significant bit of an understatement there to those types of pensioners.
Yeah, it is. I mean, for us, it's obviously, as a business, it's going to present a lot more tax planning opportunities. For a lot of clients, they're going to be worried about what they hear, and that's what we're here for. We're here to talk to them about, once we know what the new rules will be and how to sort of plan around it, we can then give appropriate advice. But the main thing at the moment is, that it doesn't. We hope it doesn't dissuade people from building money up in a pension, because pensions are still the most tax efficient way to save because of all the tax breaks that we talked about and the tax free building that you get within the pension.
Yeah, and like we say, the advantages of putting money into a pension, whether you have a company or not, as you touched on, are still very beneficial and by far outweigh any other strategy. If the main concern is leaving too much behind and paying huge amounts of inheritance tax, then there are other methods such as purchasing an annuity, which seems to have fallen out of fashion in recent years. But I assume an annuity, you buy a product that guarantees an income for life, doesn't pass on when you die. Are you seeing many people starting to think about going down that route with the new rules coming in?
Absolutely, but more so than ever. I mean, the two main ways so when we talked about the de-accumulation, so paying money out of your pension to give you an income for life, there's two main ways to do that. One is through income drawdown, which is just drawing from your pot and making sure it doesn't run out. The second way, absolutely, is looking at annuities, which is just taking the money you've got and finding an insurance company that will give you the maximum income guaranteed for the rest of your life.
Yeah.
And annuities, we've found a lot more people now, because interest rates have been higher in recent years, annuity rates have been a bit better than they were in the past. So a lot more people are taking that option because it does give a guaranteed income. And again, when we do look at pension accumulation for clients, we run a separate risk questionnaire for them to ask, right, now we're not building your money. Now, it's all about maintaining your money for the rest of your life. How do you now feel about risk? And for a lot of people, they do drop the risk level. For some people, absolutely annuities, because they're the lowest risk possible, because it is a guaranteed income for life. A lot of people are choosing that option now. They just don't want to risk income in retirement. So they swap their pot of money for that income. And there's various options you can bolt onto an annuity. So if you have somebody to leave money to, so a spouse, let's say, you can have spouse options where if you pass away, it then pays the spouse some income as well. So it's guaranteed income for life for them.
More flexible then,
and the more options you put on, the less income you get, but the more it will provide somebody else with income in life as well.
So when are we expecting to have sort of the final written rules so we know what is actually going to be happening in 2027?
Really good question. I mean, they're working on it at the moment. We haven't had a definite date. We hope it will be in the next year to give us time to make some new plans. As soon as we hear, then we will let clients know. There's no set date yet.
And in terms of your role in this, John, you're at the coalface. You're dealing with pensioners and taxpayers face to face. Someone wants to inquire to Lovewell Blake and want our assistance. They would deal with you personally.
Absolutely. Yeah. So it's me that would be giving the advice. I've got a team obviously that can help prepare presentations to things for clients. But it comes to me.
Fantastic. Look, I think this is worth a revisit once we do have a little bit more clarity specifically on those 2027 rules around inheritance tax. But in the meantime, I'd like to sort of thank you for your time, second appearance, and I think this has been very, very useful. Lots and lots of content in there. So anybody wants to get in touch, speak to John and his colleagues, please do so. But in the meantime, thank you very much, John.
Thank you.
And thanks everyone for listening.